Okay, so in the world of investing, there's this piece of conventional wisdom, right? Buy and hold. We all kind of grew up with it. Sounds simple. But what if that advice is actually, well, one of the biggest Wall Street fairy tales out there today? Today, we're taking a deep dive into some powerful ideas that really challenge everything we thought we knew about building wealth and protecting our investments.
Yeah, it's fascinating because the whole market environment has shifted so dramatically. Our source material today, John Nyaradi's Super Sectors, basically argues the old rules just don't apply anymore. So this deep dive, it's really about giving you the tools to understand that new landscape, maybe spot where the real opportunities are, and potentially avoid the pitfalls that have caught so many people off guard.
Right. And our mission here is to pull out the most important nuggets from Yaradi's work and also insights from dozens of other top investors so you can walk away really well informed about active management, sector rotation, and these super sectors that could define the next decade. Okay, first up, let's tackle this idea of buy and hold. Why is it now being called a dead concept? What does Nyaradi's book show about its performance, especially more recently?
Well, the Nyaradi presents some pretty compelling data. He highlights these significant market shifts. For instance, between 2000 and 2010, the S&P 500 delivered a negative real rate of return.
Negative.
Yeah,
Wow.
a whole lost decade for passive investors. And that doesn't even account for inflation, which, erodes purchasing power even further.
And his book came out a while ago, but that pattern seems to keep repeating, right? These long sideways markets, these brutal bear phases.
Exactly. It continues to challenge those traditional strategies.
Mhm.
His core argument about avoiding big drawdowns feels just as relevant today. We've seen these ultra bears, declines of nearly 50%. Think 1973, 74, 2002, 2008, and recovering from those. It can take years. The 1929 crash took 25 years just to break even. The 73-74 bear, 8 years. And what's really concerning, Urati points out that over the last 80 years or so, investors have actually spent about 60% of their time in these secular bear markets.
Those break-even figures are just stark. A 50% drop needing a 100% return just to get back to even, that really drives home the importance of preserving capital. Makes perfect sense why Urati would champion Warren Buffett's rules. Don't lose money, and don't forget rule number one.
Yeah.
But, for many investors, buy and hold still feels like the default. It's like a financial security blanket. What's the biggest misconception, maybe the emotional hurdle people face when they see data like this?
That's a great point. That emotional attachment is powerful. Urati really emphasizes that the rapid pace of change, the frequency of these big market shifts and those huge drawdowns,
Mm.
they make buy and hold a high-risk strategy now,
Hmm.
especially if you're nearing or in retirement.
Right.
The biggest misconception, probably that history will just repeat itself nicely, ignoring how much the market structure and the global economy have fundamentally changed.
Hmm.
And it wasn't just buy and hold. Other conventional wisdom, like broad asset allocation, that failed spectacularly in 2008 when almost everything became correlated and lost value together.
Yeah, I remember that. Scary stuff.
So if traditional approaches aren't reliably working, the alternative isn't just about making more money, it's fundamentally about preserving the capital you already have.
It's a really compelling argument against that traditional wisdom. But what about the pushback? People say active management often has higher fees, or that market timing is just notoriously difficult, almost impossible. How does Nirati counter that?
He tackles those head on. Look, active management can have higher fees, sure. But Nyaradi's point is that the potential benefit of avoiding, say, a 50% drawdown, which needs that 100% gain just to recover, far outweighs maybe a percentage point or two in annual fees.
The cost of inaction.
Exactly. The cost of a lost decade or getting hammered in a severe bear market is just far greater. And on market timing, his approach isn't about predicting day-to-day noise. It's about identifying and writing significant trends, rotating between sectors. It's more about being tactical, not just being in all the time, no matter what. He argues that with the right tools, it becomes less guesswork and more about systematic adaptation.
Okay, so we've established the challenge with traditional buy and hold. The natural next question is, what's the alternative? Nirati's answer seems clear. Sector rotation using exchange-traded funds, ETFs. Why are ETFs such a powerful tool for the strategy today?
Oh, ETFs really are a game changer here. They give you immediate diversification, like a mutual fund, because they hold a basket of securities. But the benefits are superior in many ways. Significantly lower costs, typically. No early redemption fees, usually no hefty minimums to get started.
And transparency, right? You know what you own.
Full transparency, exactly. You always know what's inside. And crucially, They trade all day long, just like individual stocks. That gives you flexibility mutual funds just don't have.
That's a big difference.
Huge. Think about it. Back in 1993, there was just one ETF. By 2009, when Nyaradi was writing, there were over 830 in the U.S. alone. Today, it's well into the thousands. They cover basically every imaginable asset class, international indexes, specific countries, commodities, even really niche subsectors like steel or solar power.
Wow.
You can even find inverse ETFs now, designed to go up when a market goes down. You can use those in retirement accounts, where short selling isn't usually allowed. This massive expansion just underlines their power and versatility for sector rotation.
That versatility is impressive, but I can imagine for someone thinking about active management, seeing thousands of ETFs, that could feel overwhelming. How does Nyaradi suggest you actually navigate that landscape to do sector rotation effectively?
Right, good question. Historically, sector rotation was pretty tied to the economic cycle. You focused on maybe 9 basic sectors: technology, financials, energy, etc. But Nyaradi introduces what he calls the new science of sector rotation. He argues that the Great Recession and all the unprecedented government intervention and massive liquidity that followed have kind of compressed and distorted market moves.
So the old playbook doesn't work as well.
Pretty much. Instead of a smooth, predictable cycle driving rotation, sometimes you see everything moving together. But even when that happens, certain sectors still emerge as clear leaders, often way outperforming the general market averages. So the key insight is, don't limit yourself to those traditional 9 sectors. That means you might miss huge opportunities in alternative asset classes that are now easily accessible through ETFs. It's about broadening your view beyond just the economy to look at the megatrends driving specific industries.
Okay, so armed with ETFs and this broader view, how do we actually rotate between sectors in a disciplined way? Nyaradi details different trading systems, simple to complex. Can you give us a flavor of how those work?
Certainly. For someone who's busy, maybe doesn't want to be glued to the screen, a simple long-term trend-following system can be surprisingly effective. He calls one almost like buy and hold. It basically tracks the S&P 500 ETF, ticker SPY, against its 70-week simple moving average.
Okay, what's that average mean?
It's just the average closing price of the ETF over the last 70 weeks. Pretty straightforward. The idea is simple. You buy SPY when its current price crosses above that long-term average that signals an uptrend. And you sell it, move to cash, when the price drops below the average, indicating a likely downtrend.
So it keeps you in during big uptrends, but gets you out during major downturns.
That's the goal. And this system, for example, showed significant outperformance compared to just buying and holding from 1995 to 2009. It captured gains, but crucially avoided those major bear markets.
Interesting. Any others?
Yeah, and another popular one he mentions is the golden crossover. This uses 2 moving averages: the 50-day, which is shorter term, and the 200-day, which is longer term. When the shorter-term 50-day average crosses above the longer-term 200-day, that's generally seen as a buy signal. When it crosses below, that's your sell signal. It tends to be a bit more responsive than the 70-week system, helping investors sidestep large declines and maybe catch rebounds quicker.
These systems definitely sound robust for managing risk, especially avoiding those big drops. But, even with clear signals, the psychology must be huge. It reminds me of that classic investor cartoon. 2 people looking at a chart. One says, I bought here, the other, I sold here, and the person in the middle says, I lost money on both trades. Nyaradi's 3 secrets seem aimed squarely at removing that emotional roller coaster. Which one do you think is the hardest for people to actually stick to?
Oh, absolutely. The biggest enemy isn't the market itself, it's our own emotions, right? Greed and fear just drive irrationality. It makes investors overtrade or take way too much risk or just let their ego get in the way of smart decisions. Like I often tell people, the market doesn't care one bit about your feelings, but your feelings can definitely hurt your market results.
So true.
Nyaradi outlines these 3 secrets of trading success to fight that. First, follow your indicators no matter what. Stick to the system signals, no second guessing. Second, honor your stops. Preset stop-loss points are basically your insurance policy against catastrophic losses. They protect your capital automatically.
Crucial.
And third, place your trade and walk away. Avoid constantly checking, constantly tweaking, letting that short-term noise dictate what you do.
That third one, walk away. I bet that's the toughest.
Yeah. It often is, because it means letting go of that feeling of control and actually trusting the system you chose. It takes real discipline. He even references Sun Tzu's Art of War, emphasizing preparation, knowing yourself, and discipline, all crucial for winning, whether in battle or in trading.
Okay, now for the part I think many listeners have been waiting for, let's talk about identifying these super sectors. The ones Nyaradi believes are likely to outperform because of these massive societal and financial megatrends. Which areas should we be watching?
Right, this is exciting stuff. Urati identifies 5 key super sectors driven by really undeniable long-term global shifts. First, the rise of Asia, especially China. Look, China is on a path to become the world's most powerful economy. This isn't just a guess, it's a trajectory. It demands vast amounts of raw materials, energy, capital. This shift in economic and financial power away from the West is just undeniable.
And not just China, right?
No, beyond China, you have countries like South Korea, Malaysia, Singapore, Taiwan, Vietnam, all experiencing immense growth. Prominent investors like Jim Rogers have been saying for ages, teach your kids Chinese and get involved in natural resources in Asia, recognizing this fundamental power shift.
Okay, that's one. What's number two?
Second, energy. Global oil supplies are finite. They're dwindling relative to demand, and demand is insatiable, especially from rapidly industrializing giants like China and India. Plus, you have geopolitical instability in major oil-producing regions, adding risk and volatility.
Yeah, that seems like a constant.
Experts have pointed out that just keeping global oil supply flat for decades would require massive, unprecedented new discoveries, like finding 4 Saudi Arabias, as Matthew Simmons put it. So rising prices seem highly likely long-term, shifting wealth to exporters. This megatrend creates opportunities not just in traditional fossil fuels, but also in alternatives. Nuclear power, for instance, could see a big resurgence as countries seek energy independence, especially in crisis situations.
Makes sense. What's the third super sector?
Third, healthcare. This is largely demographics driven. The aging baby boomer generation, we're talking 78 million people, with thousands turning 60 every single day.
That's a huge demographic weight.
Enormous.
Yeah.
And it creates this unrelenting demand for healthcare services, pharmaceuticals, specialized care. U.S. national healthcare spending just keeps climbing, way past the $4.4 trillion projected back around 2018. This medical monster, fueled by demographics and, frankly, political unwillingness to cut benefits, just offers continuous, robust growth potential, almost regardless of the broader economy.
A very defensive long-term play. Okay, number four.
Fourth, technology. It's all about exponential change here. Change that far exceeds our linear expectations. The internet, smartphones, broadband, they've already completely transformed our lives.
Yeah.
And now you have emerging tech like robotics, nanotechnology, AI, poised for even more dramatic impact. Global connectivity is like the new interstate highway system. Countries like China and India are seeing explosive growth in internet users. Thinkers like Ray Kurzweil famously project we'll see something like 20,000 years of progress just in this century. That acceleration is key.
Mind-boggling. And the fifth super sector.
Fifth, financials. Now, this sector went through cataclysmic changes after 2008. Unprecedented government intervention, the whole too-big-to-fail reality for major banks. This actually creates unique opportunities, sometimes called Buffettology, buying quality institutions, when others are fearful, especially if they seem undervalued and positioned for recovery or growth.
So opportunities born from crisis.
Exactly. And beyond the banks themselves, you look at related subsectors. Global currency markets, think about the long-term trends for the dollar versus maybe the yuan. Interest rates likely to rise from near-zero levels over the very long term. Precious metals like gold as a hedge against inflation or crisis. These areas offer significant volatility and tactical trading opportunities. Even back when Nyaradi wrote the book, someone like Mark Faber was pointing to a long commodity bull market and underinvestment in gold. Those underlying drivers, still very powerful today.
Okay. 5 huge areas driven by massive trends. So pulling it all together, what does this mean for you, the individual investor trying to navigate these really dynamic times?
Well, if we connect this back to the bigger picture, the consensus from many experts, Nyaradi sites and others since, is that just passively buying and holding is getting increasingly risky. Keith Fitzgerald calls it buy and hope. He argues consistent, disciplined, active management is head and shoulders above. Todd Harrison, another voice, suggests combining different types of analysis, fundamental, technical, structural, even psychological metrics. He aims for a high quack count. That's his term for when multiple independent signals all line up, giving you much greater conviction in a trade or investment thesis.
A quack count. I like that.
Yeah, it's memorable. But the overarching message is really clear. Adaptation, critical thinking, and a disciplined approach. They're not optional anymore. And as Paul Merriman emphasizes, even if you are timing the market or rotating sectors, asset allocation, deciding where to put your money broadly, is still always the most important decision. What stands out to you in all this?
Today's deep dive into super sectors has really just hammered home a fundamental truth. The investment landscape is constantly evolving. The days of just passively buying and holding might genuinely be behind us, replaced by this much more dynamic world where active management, powered by tools like ETFs, and crucially, a deep understanding of market psychology, seems key to success.
Yeah, and that raises an important question, doesn't it? In a world with such profound economic and social mega trends reshaping everything, the ability to identify and adapt to those shifts is just paramount. The insights from John Nyaradi and the other experts we've touched on, they provide a kind of roadmap. Whether you're looking for simple ways to just sidestep the worst of the bear markets or aiming for more sophisticated tactical trading.
Absolutely. Our hope is that this conversation really empowers you, the listener, to look at your investments with fresh eyes, armed with knowledge to make more informed decisions for your own situation. So let's end with a provocative thought for you to mull over. If change is the only constant, as the saying goes, and the global economy is constantly reordering itself, what seemingly stable investment belief that we hold today might be the next fairy tale to crumble.